My channel is dedicated to analyzing stocks and finding value in the markets, no matter what the overall market conditions are. And every month, I make a video on the stocks that I think are looking interesting and provide some quick analysis to explain why. So this is going to be my stocks that are looking cheap in June of 2024 video. And in this video, we are going to cover a little bit of everything. Before we get into the video though, I just want to say thank you to everyone who has joined my Patreon. My Patreon has been seeing a lot of new signups, and I can't thank you all enough for supporting my work here on the channel. For those of you who may not know, I post tons of additional content for my Patreon members, such as weekly Q&As, in-depth stock analysis, monthly updates on my portfolios and my holdings, and they also get access to my personal Discord. So if you would like to support my channel and get a lot more content from me by doing so, then consider joining my Patreon as well. But with that being said, let's hop right into the video. Alright, so the first stock in this video is going to be Lululemon. Lululemon is in the fashion industry and provides athletic and high quality apparel for both men and women. Now, if we also take a look at Lululemon's stock chart right here, we can see that the stock is down roughly 40% from its all-time highs. So this stock is in a pretty serious correction right now. If we also take a look at Lululemon's 5-year stock chart, we can see that the first time Lululemon hit about $300 a share was all the way back in June of 2020. So now the stock has been flat for about 5 years. But over this time, the underlying business and its fundamentals have continued to grow. And on my channel, I always love finding stocks where the stock price has not risen, but the underlying fundamentals have been growing for a very long period. So then my question was, why is Lululemon's stock down? And as of their most recent financial reporting, we can see that the company's America's net revenue increased by 9% year over year. And I think that this is why the stock is down, because this was the first time that Lululemon's America's business saw growth of less than 10%. So the overall business of Lululemon is actually continuing to grow, but the growth rates in America specifically do look like they are slowing down. And I think the market is selling off Lululemon stock because its America's business is by far the largest segment of the overall business. So it seems like Lululemon is seeing a slowdown in its major markets. However, if we take a look here, we can see that Lululemon's international net revenue increased by 54% year over year. Its same-store sales in America also increased by 7%, and its international same-store sales increased by 43% year over year. Lululemon's gross profit also increased by 25% year over year. Its gross margin expanded. Its income from operations increased by 191% year over year, and its operating margin expanded massively. Diluted earnings per share were also up more than 400%, and the company repurchased about 100,000 of its own shares. So overall, it does look like Lululemon's business is continuing to grow. Again, it just looks like its America's growth rate is starting to slow down. So now let's go and take a quick look at Lululemon's cash flow statement. And right here we can see that in the year of 2023, they did stock-based compensation of about $93.5 million. However, operating cash flow was about $2.3 billion. So stock-based compensation is a pretty low amount of overall operating profits, which is a good thing to see. We can also see that operating cash flow more than doubled year over year, so the company's operating profits are growing extremely well. Then we can see that capital expenditures were $652 million, which means that Lululemon produced about $1.6 billion in free cash flow for the year of 2023. Then we can see that they used this cash flow to buy back about $558 million worth of stock, and also increase the company's cash position by about $1.1 billion organically from the company's profits. So it seems like Lululemon spent about 1/3 of its free cash flow on buying back shares, and then the rest of it went to growing the company's cash position. And if we actually head over to Lululemon's balance sheet right here, we can see that cash and cash equivalents are sitting at $2.2 billion as of the most recent report, which is up about $1 billion year over year. Then we can see the company's total current liabilities are sitting at about $1.6 billion. So Lululemon does have more cash on the balance sheet than current liabilities, and it's also generating a significant amount of free cash flow, which ultimately suggests that Lululemon does have a strong balance sheet and it is a very profitable business, and that the company should not be in any financial stress anytime soon. So now if we head back over to Stock Unlock, we can take a little bit of a longer look at the company's overall growth. And we can see here that again, the revenue is sitting at all-time highs of about $9.62 billion. And the revenue growth of this business has been incredible over the past 20 years now. If we also take a long-term look at its operating cash flow right here, we can see that operating cash flows are exploding and sitting at an all-time high of that $2.3 billion. So it seems like the company's overall fundamentals are sitting at an all-time high right now. So now let's go and take a look at Lululemon's price today. And it is trading for a price to operating cash flow of about 17.6 right now. And the company's 10-year historical average has been about 35. So it's trading for about half of what its 10-year historical average price ratio is. We can also see that the lowest its price to operating cash flow got over the past decade is 16.8. So it is trading right near its historical lows at this time. And then lastly, we can see that Lululemon's price to operating cash flow was about 33 in the stock market crash of 2020. So the company, in terms of its operating profits, is trading significantly below where it was in the stock market crash of 2020. So based on this data, it does seem like Lululemon is quite cheap in the market right now, at least relative to how the market has historically valued this business. Now lastly, let's take a look at Lululemon's outlook for 2024, because here they say that they are expecting revenue to grow by about 11 to 12% this year. So it seems like the company is still projecting growth for the year of 2024. However, if we head over to the income statement and go to the yearly revenue growth and add in the percent change, we can see that the lowest revenue growth Lululemon ever had was in the year of 2021, with about 10.6% revenue growth for the year. So it seems like the company is expecting another weaker year in 2024, and we can also see that the revenue growth has been dropping since about 2022, when the company grew its revenue 42% in that year. So overall, it does seem like Lululemon's revenue growth is slowing down, which could again be why the market is selling off the stock. However, again, the company is trading near its decade low price to operating cash flow, and it is still a growing business. Revenue is at an all-time high. The business is projecting revenue to continue growing at double-digit growth rates, and its operating profits are at an all-time high as well. Now, for me, Lululemon is not a stock that I plan on adding to my portfolio, because I do not invest in the fashion industry. The fashion industry is out of my own circle of competence because I don't understand which brands are going to resonate with consumers over the next decade, or which brand consumers are going to be buying in 2035. And since I cannot predict which brands are going to be strong over the next 10 to 20 years, I simply have a rule for myself where I do not invest in the fashion industry. With that being said though, purely looking at Lululemon's financials right now and its price today, I do think that it does look like a very interesting stock that is selling near its all-time lows in terms of its price ratios and still growing. And for those reasons, I did want to put this one at the beginning of the June cheap stocks in the market video. Now let's move on to the second stock in this video, which is MELI or Mercado Libre. MELI has been featured in both my April and May stocks that are looking cheap videos, and I believe that MELI is still looking cheap. I also finally pulled the trigger and recently bought some MELI shares in my personal portfolios. But for those of you who may not have seen my April and May stocks videos, MELI is like the Amazon of South America. It is not entirely the same business as Amazon, but it is very similar. MELI doesn't have a cloud business, but it does have an e-commerce business, an advertising business, and a financials business. MELI is also the leading tech company in South America. It also got awarded the top 5 market cap of e-commerce companies worldwide and one of the most valuable brands in the world. MELI also says that they are democratizing commerce and financial services in Latin America, a region where e-commerce is far from mature and financial services are ripe for disruption. Our markets have a combined population of over 500 million people and a GDP of $5 trillion. And then here once again we can see that MELI's market population is 516 million people. The $5 trillion GDP number is also 1/5 of the United States GDP. So the market is pretty large and still growing, which does suggest that MELI has a long runway for future growth. Latin America e-commerce penetration is also around 12%. And when you compare that to China, the United States, and the UK, it is actually still a low e-commerce market penetration and does suggest that Latin America's e-commerce market can continue to grow over the long term. Then down here we can see that the large banks in Brazil are also being disrupted by fintechs like MELI, and the big 5 Brazilian banks are losing market share to these other disrupting fintech companies, again like MELI. MELI's gross merchandise value is also growing faster than the overall Latin America market. This means that MELI continues to take market share in the overall e-commerce market, again because it is growing faster than the overall market. Now this next slide from MELI's investor presentation shows that its digital ads revenue is absolutely exploding. In fact, it's up 62% from 2022 to 2023. That is a massive growth rate to MELI's overall ads business. Additionally, MELI is taking market share in the digital ad space down in Latin America, and its market share has more than doubled from 2% in 2021 to 5% in 2023 now. So MELI's ads business is growing incredibly quickly and is taking market share as well. Now this next slide discusses MELI's fintech business, and we can see that they have 45 million monthly active users on their fintech platform. The fintech platform provides credit and debit cards, consumer merchant and credit, online and offline payments and transfers, saving and investment accounts, and insurtech. So MELI is basically an online banking platform that is growing incredibly quickly. Here we can see that MELI's fintech revenue was $1.24 billion in 2020, and today it is sitting at $7.23 billion in the trailing 12 months. This is growth of about 500 to 600% over just the past 4 years. Now, continuing on to talk about future growth, this right here from Google says that Latin America e-commerce shoppers is projected to grow by 44% by 2029. Additionally, Brazil is projected to see 111% e-commerce growth from 2022 to 2027. Mexico is 99%, Colombia is 60%, Chile is 72%, Peru is 78%, Argentina is 109%, and the rest of Latin America is 84%. So there is a lot of runway for future growth for MELI in South America over the next decade. So now let's head back over to Stock Unlock, and I want to show you all MELI's long-term revenue growth because it's honestly pretty insane. So right here we can see that back in 2009, MELI was generating about $147 million in revenue. And we can see that the revenue has now exploded to $15.8 billion in the trailing 12 months now. If we also head over to MELI's operating cash flow, we can see that it is at an all-time high of $5.8 billion, and it is absolutely exploding as well. Now, what's interesting is MELI is trading for a price to free cash flow of only 16.7 today, which is a free cash flow yield of 6%. So MELI is a business that has been growing incredibly well and consistently over the past 20 years. Additionally, this company is projected to have strong growth going forward, and the markets that it operates in do seem like they have a long runway for future growth. So MELI has a history of incredible execution and a long runway in front of the company. Yet despite the past history of this business and its historical performance, it's still only trading for a price to free cash flow of 16.7. This is cheaper than stocks like Meta, Apple, Google, Microsoft, Amazon, and etc. Yet the business is growing significantly quicker, and in my opinion has a larger market opportunity in front of it. And since this business is trading for a low price ratio with such strong growth, I do think that it is looking cheap in the market still, and these are the reasons why I have added MELI to my personal portfolios recently. Alright, but now let's move on to the third stock that I want to talk about in this video, which is Brookfield Asset Management, or the ticker BAM. BAM is actually the second largest position in my personal portfolios, and I have been making videos on my channel about Brookfield Asset Management since it became a public company all the way back here in about December of 2022. Brookfield Asset Management is a spin-off from Brookfield Corporation, and this is the asset management segment of the business. It's a highly profitable business that is also projecting to grow at 15% annually over the next 5 years, so I do think that it is a very interesting dividend-paying stock in the market as well. So let's start off by discussing what Brookfield Asset Management actually does. And here they say, we are one of the largest and fastest growing alternative asset managers in the world, distinguished by a 100+ year history of owning and operating real assets and businesses operating in over 30 different countries. Brookfield Asset Management has renewable power and transition, infrastructure, private equity, real estate, credit, and other in its portfolios. It also has $929 billion in assets under management now. So Brookfield Asset Management manages capital within all of these different industries. And now if we move on to the next screenshot from its most recent investor presentation, they show us the Brookfield ecosystem, and they say, the Brookfield ecosystem spans the core sectors that keep the global economy running. These sectors are hospitality, housing, business services, transportation, industrials, midstream, wind, utilities, solar, hydro, office, energy transition, logistics and self-storage, retail and entertainment, technology services, healthcare, and data. So these are a lot of different industries that Brookfield Asset Management manages capital in, and we can see that overall, these sectors are what power the global economy. And Brookfield prides itself on being the business that owns, operates, and manages the backbone of the global economy. And very much so, this is what the company does. Brookfield also says that investors worldwide are turning to alternative assets, As institutional investors increase their allocations to alternatives, the overall industry saw rapid expansion and is estimated to grow to $25 trillion by 2028. In 2010, alternative assets under management was $4 trillion globally, and in 2023, it more than 4x'd to $16.3 trillion in assets under management. And by 2028, this number is projected to grow to $24.5 trillion. So institutions around the world are continuing to allocate more of their funds to alternative asset managers like Brookfield Asset Management. And this is acting as a tailwind for Brookfield Asset Management as well. Now, this next slide shows us Brookfield's own projections over the next 5 years. And we can see that they are expecting their fee-bearing capital, or FBC, to compound by 23% annually and be worth over $1 trillion by 2028. Which is more than double the company's $459 billion today. Brookfield Asset Management's fee-related earnings, or FRE, is projected to grow by 19% annually over the next 5 years as well, and produce $4.8 billion in earnings by the year 2028, which is more than double the $2.2 billion of trailing 12 months earnings that the company has generated. So it is projecting to more than double its earnings over the next 5 years, which is a compounded annual growth rate of nearly 17%. This next slide from Brookfield shows some of their KPIs, or key performance metrics. And the highlights here are that Brookfield Asset Management has a 55 to 60% net margin. So this is a very high margin and profitable business. It's also projecting 15 to 20% annual growth to its earnings, which we saw in the previous slide. And then the company wants to pay out 90% of those earnings as a dividend to shareholders. And this is one of the reasons why I think that Brookfield Asset Management is such an attractive dividend growth stock in the market. And I actually argue here on my channel that this is the best dividend growth stock in the entire market. And the reason is because it pays a nearly 4% dividend on the cost of the shares today, and it is projecting to grow its earnings at 15 to 20% annually, and then redistribute all of that earnings growth back to its shareholders. So ultimately what that means is that Brookfield pays a 4% dividend today, and that dividend is projected to grow by 15 to 20% annually. And in my years of investing, I have not found a single other business with that high of a dividend yield on cost and that much future projected growth. And that is ultimately why I do think that Brookfield is a very attractive business. Additionally, Brookfield says here that they have no debt on the balance sheet, and the company has about $2.6 billion in cash. So a very strong balance sheet as well. Now, if we head back over to Stock Unlock, we can see that Brookfield Asset Management has a market cap of $15.26 billion today. So what we can do is enter this into our calculator, and we also saw that Brookfield Asset Management has no debt and $2.6 billion in cash. So I want to subtract this cash position from the market cap to find the company's enterprise value. And here we can see that the enterprise value is $12.66 billion. Now, in the trailing 12 months, Brookfield Asset Management, the ticker BAM, has produced about $586 million in earnings for its shareholders. So what this means is that the business is trading for an enterprise value to earnings of about 21.6 today. And in my opinion, this is an attractive price for a business that is projected to grow its earnings by 15 to 20% annually and redistribute those earnings in the form of a dividend to its shareholders. So I do not think that Brookfield Asset Management is very expensive in the market today. This also means that by 2028, BAM should have an 8% dividend yield on cost of shares purchased today if they can meet their growth targets, and the stock should be worth around $67 by 2028 as well. The share price growth plus the dividends paid could also yield a 14.5% compounded annual growth rate from today's price, again, if Brookfield can actually meet its targets. And again, with a nearly 4% dividend yield with 15% plus projected dividend growth, this is the reason why I say that BAM is the best dividend stock in the market. All right, now let's move on to the fourth stock that I want to talk about in this video, which is Amazon. Now, Amazon was also featured in both my April and May stocks that I think are looking cheap videos, but Amazon I still think is looking cheap, and it is one of the Magnificent 7 stocks that I do own in my portfolio, and I do not think is looking overvalued today. And allow me to quickly explain why. So if we head over to Amazon's financials here and take a look at its revenue, we can see that revenue is sitting at an all-time high, and its revenue growth is not slowing down at all. It's continuing to grow very well. Now, if we head over to Amazon's operating cash flow, which is the key metric that I focus on for this business, we can see that Amazon's operating cash flow is absolutely exploding and is now sitting at $99 billion in the trailing 12 months. This is absolutely incredible cash flow growth from Amazon's business. Now, if we take a look at Amazon's most recent earnings report, we can see that its third-party seller services produced $34.6 billion in revenue, and it is growing at 16% year over year. Advertising services also produced $11.8 billion in revenue for the quarter, and it is growing at 24% year over year. Subscription services is now at $10.8 billion in quarterly revenue and growing at 11% year over year, and AWS is at $25 billion in quarterly revenue, growing at 17% year over year. Now, the reason that I want to point this out is because a lot of people talk about Amazon in terms of AWS, and a lot of people think that AWS is like the gem of Amazon's business. But look at this. Third-party seller services is a larger business growing basically just as quickly. The advertising business is also a $12 billion per quarter business now, growing at 24% year over year. And Amazon has 4 different business segments that are producing over $10 billion in quarterly revenue and growing at double-digit growth rates. So in my opinion, Amazon is so much more than just AWS, and these are very profitable segments of the business growing at strong growth rates. And as these business segments continue to grow over the long term, I do expect Amazon's profits to continue growing substantially as well. Here is also a chart I found from 4-Week MBA showing Amazon's different business segment growth from 2015 to 2023. And here we can see the overall different businesses and how quickly they are growing. So that's a pretty interesting screenshot that I found as well. This next screenshot shows the different advertising businesses and their advertising revenue growth. So we can see that YouTube's 3-year compounded annual growth rate to revenue is 10%, Amazon's is 23%, Meta's is 12%, and Google's is 13%. So Amazon's advertising business is the fastest growing advertising business right now by far, which also suggests that Amazon's advertising business is taking market share from the overall advertising space. In fact, here I have the market shares of Google, Meta, Amazon, Microsoft, and TikTok in terms of advertising spend in the United States. And we can see that in 2020, Amazon had about 10% of the overall market share. And in 2024, it now has about 14% market share. And in 2025, it is projected to grow to about 15.2% market share. So Amazon advertising is actually taking market share from both Google and Meta and even YouTube. And it is, again, the fastest growing advertising business out of all of these major tech companies. Now, on top of that, we can see that AWS has now done $94.4 billion in trailing 12 months revenue and produced $28.9 billion in operating income for Amazon. And the operating income and the operating margin is starting to expand once again, and AWS's overall revenue growth is starting to accelerate once again as well. So this is very bullish to see for Amazon, and as AWS continues growing over the long term, I am expecting Amazon's operating cash flows to continue growing as well. So now let's head back over to Stock Unlock, and we can see that Amazon is currently trading for a price to operating cash flow of 18.5, and its 10-year average is about 27.5. So it is trading significantly below its historical average price to operating cash flow. Also, the lowest Amazon's price to operating cash flow got in the past decade is about 18.1. And again, it is trading for 18.5 today, so it's basically trading at its 10-year low price to operating cash flow. And this is why I think that Amazon stock is still looking cheap in the market today, because relative to how the market has historically valued this business, it is on the very low end and selling well below its historical averages. Here we can see that during the stock market crash of 2020, Amazon was also trading for a price to operating cash flow of 23.4, so it is significantly below where it was trading during the stock market crash as well. Now, another thing that I want to point out is Amazon's operating cash flow is growing extremely quickly. If we compare Amazon's operating cash flow to Microsoft's operating cash flow, we can see that Amazon is about to surpass the amount of cash flow that Microsoft generates. And Amazon's operating cash flows are growing significantly quicker, which is also interesting to me because if we take a look, Amazon is trading for that 18.5 price to operating cash flow, and Microsoft is trading for 28. So Microsoft is trading for a significant premium to Amazon right now, despite Amazon actually being the faster growing business in terms of its operating profits. And it's also worth pointing out that this was not always the case historically. For example, back in 2019, Amazon's price ratio was actually trading for a premium to Microsoft. But recently, this has actually switched, and now for some reason, Amazon is the stock in the market out of the Magnificent Seven that is trading for one of the lowest price to operating cash flows, and I don't really understand why, because in my opinion, Amazon has one of the best moats in the world, and should actually be trading for a premium, if anything, especially when we consider that Amazon's cash flows are growing significantly quicker than Microsoft. So overall, with Amazon trading near its historical low price ratios, growing faster than the other Magnificent Seven stocks, and trading at a discount to them, it leads me to believe that Amazon is actually quite cheap in the market right now, and it is the Magnificent Seven stock that I would be buying and increasing my position in. However, personally, I am happy with my exposure to Amazon, so I'm not buying more Amazon stock at its current price. But if I did not have a position already, then this is definitely a stock that I would be interested in right now in the market. All right, but now let's move on to the fifth and final stock that I want to talk about in this video, which is REXR, or Rexford Industrial Realty Inc. Very quickly, REXR is an industrial real estate company, specifically in the California market. So they own, operate, manage, and acquire industrial real estate throughout California. Now, I actually made a full in-depth video discussing why I think that REXR is looking cheap in the stock market right now. So let me quickly summarize my thoughts on this business. And it really stems from the stock being down about 46% from its all-time highs. And if we go all the way back here, we can say that the first time that REXR traded for $44 a share was in September of 2019. So now the stock has been flat for about 5 years. But if we go and take a look at REXR's financials here, we can see that its revenue has been growing and is sitting at an all-time high now of about $826 million in the trailing 12 months. And if we head over to its cash flow statement, we can see that its operating cash flows are at an all-time high and sitting at $442 million now. So this company's revenue and its operating cash flows have continued to grow nicely over the past 5 years, but the stock has now been flat. So the stock has done nothing, but the underlying fundamentals have continued to grow. If we also take a look at REXR's dividend payments right here, we can see that they are sitting at an all-time high and continuing to grow as well. And if we take a look at REXR's total returns versus the S&P 500 since 2013, we can see that even though the stock is down 46%, when we include the dividends, REXR is still outperforming the S&P 500 with a total return produced of about 288.5%, versus the S&P 500's total returns of 225%. So over the long term, this stock is actually still outperforming the S&P 500, and it is growing its dividends and paying a nice dividend yield, and its fundamentals are sitting at an all-time high. Now here we can see that REXR's stock is trading for about 22.4 times operating cash flows, and its 10-year historical average has been roughly 31.8. So it is trading significantly below its historical averages as well right now, and the lowest the stock has ever traded for was about 17. So it's not trading quite at its lows in terms of its price to operating cash flow, but it is significantly below its historical averages. What's also interesting is REXR is still projecting FFO per share growth of about 7 to 8% for the year of 2024. It's also projecting the same property portfolio net operating income growth of about 4.75% this year, and its portfolio occupancy is projected to be about 96.5% for the remainder of the year as well. So the company is still projecting to grow its underlying fundamentals for the remainder of 2024. So I do think that it is looking interesting while its price ratios are significantly below averages and trading on the low end, and the stock has now been flat for the past 5 years, but the underlying fundamentals continue to grow. And that is really the thesis on why REXR is looking interesting in the stock market today. And with that being said, that is going to wrap up this month's 5 stocks that are looking cheap in the stock market video. And I really hope that you all enjoyed. If you did enjoy the video, then please remember to leave a like on it because it does really help out my channel. And if you want to stick around and see more stock market related content like this, and stay tuned for my monthly interesting stocks in the market videos, then make sure to subscribe to the channel as well. And lastly, if you want to further support the channel and get even more content from me, like weekly Q&As, monthly portfolio updates, access to all of my buys and sells in real time, and access to my Discord community, then consider checking out my Patreon and becoming a member. And becoming a Patreon member is the #1 way to support my content and all of the work that I do here on YouTube. And thank you so much to the hundreds of Patreon subscribers that I already have. You guys are amazing, and I cannot thank you enough for supporting my content in such a major way. But with that being said, that is actually going to wrap up the video now. So thank you all again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.